Welcome to The Explainer. So PennyMac Financial just dropped a fantastic third quarter earnings report. I mean, they beat expectations pretty much everywhere you look. But here's the weird part. The market barely even flinched. Today, we're going to dig into the anatomy of this beat and try to figure out why Wall Street basically just shrugged. Okay, let's just jump right into the numbers. PennyMac delivered earnings of $3.37 a share. Now, that's not just a beat, it's a really decisive one, clearing the Wall Street consensus by almost 40 cents. That's a super strong way to kick things off. And it just keeps getting better. Revenue, nearly $633 million. That's a huge 53.7% jump from last year. And yeah, it also blew past all the estimates. Honestly, this isn't just a simple beat, it's a total blowout. So the big question is, how on earth did they pull this off, especially in this kind of environment? Well, the answer really comes down to their balanced business model and, you'll see, some truly exceptional risk management. Let's break that down. You see, PennyMac basically runs on two main engines. You've got production, that's the part creating new loans, and then you've got servicing, which is managing all the existing ones. This quarter, both of those engines were firing on all cylinders. Production brought in almost $123 million in pre-tax income, and servicing delivered over $157 million. That's just a powerful 1-2 punch of profitability. But, you know, in the mortgage world, there's always a catch. When interest rates fall, it's great for people looking for a loan, but it creates a real challenge for servicers. Why? Because it reduces the value of their mortgage servicing rights, or MSRs. See, when rates drop, homeowners refinance, and that income stream that the servicer was counting on just gets cut short. And that is exactly what we saw happen. This quarter, PennyMac was looking at a paper loss of over $102 million on their MSR portfolio, and that was purely because interest rates shifted. For a lot of other companies, a hit like that would have absolutely torpedoed the entire quarter. But, and this is where their strategy just shines, they have a dynamic hedging program designed specifically to counteract that kind of volatility. And that program? It generated an almost perfectly equal and offsetting gain of over $98 million. Just brilliant. So the end result was a near-perfect offset. Their expert execution completely neutralized that MSR volatility. It turned what could have been a huge loss into a tiny $4.2 million impact. I mean, it's a textbook case of financial stability and just top-notch risk management. Okay, so having a great quarter is one thing, but what investors really want to see is a clear strategy for the future. And let me tell you, management laid out a very, very confident playbook. Now this is what really gets you interested. Management is out here projecting annualized returns on equity in the high teens to low 20s for the next 2 full years. That is an incredibly strong signal about how they see sustained high-level profitability ahead. So how are they going to get there? Well, a huge piece of the puzzle is their plan to aggressively expand their share in the broker direct channel. Right now, they're sitting at just under 6%, and they're aiming for over 10% by the end of 2026. That shows you a really clear path to organic growth. And they are not just sitting still either. They're making some really smart moves with their capital. This quarter, they sold off a $12 billion chunk of MSRs, which freed up cash, but they cleverly kept the sub-servicing rights. They also locked in new long-term financing, invested in new tech, and even bought back some of their own stock. I mean, these are all signs of a management team that's playing offense. Which brings us right back to where we started. With such an amazing report, great execution, and a clear strategy, why the heck didn't the stock soar? The immediate reaction in after-hours trading was a gain of 0.6%, barely a flicker. It is just not the kind of explosive move you would expect after a quarter this strong. So what's the deal? Why did Wall Street seem to just shrug off such a blowout quarter? Well, it's that classic story of performance versus expectation, but with a little twist. And the answer is right here on this chart. You have to look at the run-up before the announcement. The stock had already surged over 25% in the 3 months leading into this report. So the market had already priced in a fantastic quarter. This impressive beat was, in a way, just meeting some really, really high expectations. So, with all that context in mind, what's our take from here? It is time for the next call. We are expecting continued strong returns on equity, pretty much right in line with what management is guiding to. We think margins are going to stay stable, maybe with a tiny bit of compression if there's a shift toward more refinancing. But critically, we see book value continuing to grow, and that provides a really solid floor for the stock price. The overall trend, we think, remains upward, with the usual warning about broader market volatility, of course. Looking ahead, here's what you should really be watching. First and foremost, the path of mortgage rates. That is everything. It's going to drive all the refi volume. Second, keep a close eye on their progress in that broker direct market. Are they hitting their targets? Third, watch what they do with their capital. More deals, more buybacks? And finally, let's see if they can execute on cost savings as their new tech investments really start to kick in.
So, what's our final call? When you put it all together, their proven execution, especially on the hedging, their strong guidance, and a really clear strategic plan for growth, our rating on PFSI is outperform. They've shown they can navigate a really tricky environment and are just very well positioned for what's coming next.
And that's our take on PennyMac's pretty impressive quarter. Just remember, this explainer is for informational purposes only and is not financial advice.